Well, let's talk business now. And markets fell after 3 days of, again, it was a choppy end to the August series. Banks and FMCG dragged the indices lower. My colleague Alex Matthew has this wrap up of all the market action. Alex.
A choppy end to the session today, and in fact a choppy end to the August series. You had the Nifty 50 lose ground today and close very close to the low point of the day, down about 0.5% or thereabouts, and in fact it ended at 19,253. Now the broader markets continued to outperform though, and you had the small cap index that gained about 1%, and you had the mid cap index that also ended with gains of about 0.3%. And we've had several conversations in the recent past with market veterans that are pointing to greed on the street, and that is an indicator where you say out of every 100 rupees that goes into the equity markets, about 50 rupees is heading into the mid cap as well as the small cap space of the market. In today's session, though, you had most of the sectoral indices lose ground. You had the PSU banks and the FMCG index that were the worst performers, as a result of which you had the Nifty Bank lose about 0.5% or thereabouts. The top gainers on the Nifty 50, Jio Financial Services. Interesting to note that today will be the last session that it will remain in the indices. It will be out tomorrow onwards. You had Maruti Suzuki that hit an all-time high in trade today. In fact, reached that 10,000 mark yet again. HDFC Life, Cipla as well as Tata Steel, the other big gainers. Among the losers, you had Adani Enterprises as well as BPCL, Adani Ports, Britannia and Eicher Motors losing ground. A few other special mentions. Aeroflex made its debut on the exchanges today, and in fact it listed at a premium of 76% to its issue price. Quite a few marquee investors in that counter. Tata Steel, Bharti Airtel, Sula Vineyards as well as MedPlus Health all saw very large trades. We'll find more details on that imminently. But among them, Sula Vineyards crashed quite a bit. In fact, it lost over 4% after that trade. Equity markets seeking direction at this point. Perhaps the GDP number that comes out later today will be one of those triggers.
While Indian markets have been an attractive destination for investors, are they fairly valued? Can there be valuation risks in the short term? Maneesh Dangi of Macro Mosaic shares his views. Do listen in.
India is very or moderately expensive, very expensive relative to China, okay with vis-a-vis US, moderately expensive vis-a-vis our historic valuations. India's earnings, people who know the internals of it can realize that in last 5 or 10 years, revenues and GDP growth have moved in tandem, but earnings in last 5 years have detrended, have grown at 25-30% faster. And no one knows, frankly, in a lot of countries that I track, the earnings are sort of rolling over to the extent that they are mean reverting, so to say. If they were to be a trend chart, India's earnings are way off. And small part of it is explained by tax cuts and such like things, but it's very likely that at some point in time, a little bit of a soft patch and these earnings actually begin to mean revert. So you don't really have valuation comfort vis-a-vis history. And there is a small risk in India, and then never trade any beta markets, including India, if you can't solve for US Treasury and S&P 500 first to begin with. So if you're bullish as US Treasuries for reasons of recession, and if you're bearish S&P 500 for the reasons of earning potential sort of downgrade, then it's very unlikely that you will be able to solve long Nifty.
Well, amidst a sharp rise in employee attrition rates, small finance banks stare at a fight to hire and retain talent. Given the limited talent pool and resources, some small finance banks have seen a rise in employee turnover rates. Pragati Oberoi joins us with all of the details. Pragati.
India's small finance banks are staring at a talent war as employee attrition has jumped significantly in FY23. Given the limited talent pool and resources, several lenders like the AU Small Finance Bank, Ujjivan Small Finance Bank, Utkarsh Small Finance Bank and the Equitas Small Finance Bank have witnessed a sharp rise in attrition. For these lenders, the attrition rate has now ranged between 35% and 48%, a trend which was also seen in India's private sector banks as per BQ Prime's previous report. But let's be very clear that the attrition in the small finance banks is concentrated among the frontline employees. For AU Small Finance Bank, the employee turnover rate increased to 47.3% in FY23 compared with 42.3% in FY22. The bank's head of HR, Vivek Tripathi, told BQ Prime that there has been some increase in turnover rate as the overall base of employees remained the same. Experts that BQ Prime spoke to explained the possible reasons for a spike in attrition. These include aggressive expansionary plans leading to increased competition within the sector, all to attract better talent. Second, the inability to pay beyond a level as small finance banks tend to have limited resources. But the problem does not end here. It comes with employee costs. BQ Prime's analysis of data across quarters showed that even the employee expenses have spiked. Now, given the current economic landscape, monitoring attrition becomes even more important. As per experts, if the SFBs are not able to attract the right talent at the right scale, it will compromise not just the quality, but also the sustainability of growth.
The global economy has been in the doldrums, with inflation touching record highs across the world and countries facing recession. Global central banks have swung into action to tame the inflation monster by raising interest rates. Can the global economy bounce back in the near term? Will interest rates continue to remain high? BQ Prime spoke to Steve Bryce of Standard Chartered and Christian de Guzman of Moody's to understand the big picture.
Yes, certainly when we look at the US economy, there's starting to be some signs at least that the economy is starting to falter here, right? So, I mean, obviously we've seen some weakness in the manufacturing sector for some time, but now we're starting to see signs that's spreading to the services sector as well. Obviously, we've got some very, very key data coming up in the coming 48 hours and into next week as well. In the form of inflation data and obviously the employment reports as well at the end of this week, and then the Beige Book, Fed's Beige Book survey next week. But overall, it seems to be painting a picture that, you know, this narrative that would see a soft landing in the US economy might be a bit of wishful thinking. And from that perspective, it's going to be a bit more challenging times, I think, for the global economy, not just for the US economy, but also for the global economy going forward, as we see this weakness finally coming through, that lagged effects of the monetary policy tightening that we've seen, really starting to feed into the economy now.
We are looking at a situation where, globally speaking, interest rates are now going to be much higher for longer, and we're not going to return to the sort of post-global financial crisis era in terms of vast global monetary easing, leading to very, very low and in many cases negative interest rates, which is then impacting places like India, which has had structurally higher interest rate environment. That had actually helped push interest rates down in India over the past few years, but we're not going to be in that situation anymore. So to the extent that the pandemic did lead to higher debt, and once again, we're not singling out India here, this applies to pretty much every country out there that was impacted by the pandemic, which is basically everyone. Everybody has balance sheets that are worse off, but to varying degrees. And in the case of India, that's in the order of 15 to 20 percentage points of GDP in terms of general government debt.